Strategies for Retirement Transitions, the Legacy Stage, on this week's edition of WealthWise. I'm Chuck Vickery with Elevate Wealth Advisory, and let's look at what this means. Last week I introduced you to the 4 phases of our financial life. I mentioned that the accumulation phase starts when you start working and it ends when you get your last paycheck. And when you get that last paycheck, you automatically enter the transition stage. And transition lasts through age 72. At age 72, distribution starts. And that means living off your resources until you're gone. And when you are gone, we have legacy, what you leave to your heirs. When you plan, there's a different order. If you don't know where you're going to end up, it makes planning very difficult and not effective. For that reason, we'll go backwards, and we'll start with legacy. We want to show you how to build a plan for you and your family to lose the least amount of wealth over multiple generations. We want to show you how to increase your odds of not running out of money while keeping your portfolio growing. We plan backwards because there's an end. And we want to know what that end looks like, and we want successful outcomes. So we start and we go backwards. So each phase we have 13 to 17 bullet points. So when we look at these points on the legacy timeline, leave assets to a surviving spouse, equalize ownership of equities, accumulate unrealized gains for tax-free step-up in basis. Now these are 3 different things, but they're all linked. And so let's start and talk about them, and we'll start with step-up in basis. It's rare when the federal government gives you something free. When they offer free, raise your hand and take advantage of it. Under current tax law, we have a free step-up in basis. Step-up in basis is when the government increases what you paid for something to its current value, and that occurs at your death. When your heirs sell it, they only pay taxes on any increase since your death. Think of your house. It's probably worth more than you paid for it. At your death, your heirs can sell it for the current value tax-free because the tax basis is stepped up to the current value. The unrealized gain vanished and was never taxed. The same is true of stocks, bonds, real estate, antiques, art, whatever. We will talk about investment consulting in another series. But to accelerate growth and unrealized gains, the only way to do it is with evidence-based investing. So if we can have money grow and not be taxed on the growth, and have it step up and not be taxed when we're gone, and our heirs can sell it and not have to pay any taxes, that's a pretty good deal. Another bullet point, fund surviving spouse's lifetime with inherited assets. So if you inherit a portfolio from your spouse, you receive it tax-free. The surviving spouse can now live off the inherited assets without paying any income taxes. And if it's enough to live on, the surviving spouse's portfolio can be positioned for growth so that it also steps up at her death. We're able to provide the family with a double step up in basis. So if we own assets the right way, they will step up at the first death and then step up again at the second death. We don't know who is going to die first. That's why one of the bullet points is equalize ownership of assets during life. If we get the double step up, heirs can liquidate assets at the second death totally tax-free. When we talk about the accumulation phase in a few weeks, we will talk about having the right assets in the right type of account so that you can take advantage of step up. So once again, decisions you make at 30 impact you at 80. Assets that pass through your will normally receive the step-up. However, certain assets are the exception. And the exception is called income in respect of a decedent, which is what the government uses for annuities, retirement plans, and government savings bond. The common denominator here is that they all offer tax deferral and they do not step up in basis at death. So your heirs receive these assets with a tax bill attached. Deferred structures are primarily retirement accounts and annuities that defer or postpone taxes. We know deferrals will end, We're just not sure when. When I'm talking about retirement accounts, I remind folks that they are forever taxed. This money's never been taxed, and when you take money out of your retirement plan, you have to pay taxes on it. And when you die and your spouse inherits it, they have to pay taxes on it. And when your spouse dies, if there's a balance, your kids pay tax on it. And if there's anything left for your grandkids, guess what? They get to pay tax on it as well. Somebody's going to pay tax on this money. And that's why we call it forever taxed. And it will be taxed at your highest marginal tax rate. There are exceptions to every rule, and there are two ways you can remove money from deferred accounts and eliminate or severely limit the tax. One way is to give to your favorite charity. Update wealth protection documents is another bullet point. We often see charitable bequests and wills when the person has an IRA. That means the charity, which is tax exempt, receives tax-free stepped-up basis assets, and your children, your grandchildren, receive the fully taxable IRA. We end up with the reverse of what we really want. Because charities do not pay taxes, let's name your charity as one of the beneficiaries of your IRA and have all the tax-free assets go to your heirs. Think about it. Would you rather inherit something that is fully taxable or that is fully tax-free? Consider holding deferred structures to fund end-of-life costs. Also, if we hold deferred structures and we need long-term care, a good way to pay for care is out of retirement accounts and out of annuities. You must include those dollars you pull out to cover the cost of care as income, but you get to write it off on your tax return. It's one of the few ways that you can take money out and pay none or very little in taxes. So match up large medical expenses with IRAs. If you need long-term care and you don't have the long-term care insurance, let's just say it's $100,000 a year, and you take $100,000 out of your IRA. You must include that $100,000 as income, but on your tax return, you write most of it off. Create a strategy for 10-year inherited IRA. Another bullet point. The Secure Act is playing havoc with estate planning. This is a law that was passed in December of 2019 that changed the age where you are forced to take money out of your retirement accounts, and it changed it from age 70 and a half to 72. It also changed how children must treat inherited IRAs. Today, if a child inherits a parent's IRA, they must liquidate it within 10 years and pay the taxes. Think about it. The last thing a successful person in their prime earning years wants is to receive a fully taxable bequest that substantially bumps up their tax rates and their taxes. By law, they have 10 years to withdraw the money and pay the taxes. If your spouse has enough to live comfortably on the rest of their life, maybe we should consider naming the children as beneficiaries of your IRA. By naming children as beneficiary of the first and then again of the second to die, we end up with 2 10-year periods and not just one. So a lot of flexibility, and it saves a lot of taxes. We always want to transfer assets in the most tax-efficient manner. Late in life, look at your tax rate versus your children's. If you're in a lower tax bracket than they are, consider accelerating withdrawals. Take advantage of different family members' tax rates when you can. Also look at circumstances of your children. If one's a doctor and the other's a school teacher, they're in entirely different tax situations. You need to have a discussion with them. They'll both benefit and have more money if you leave your $600,000 IRA to the school teacher and your $400,000 step-up tax-free to the doctor. Here again, we have difference in tax rates. At first, it looks like we love the school teacher more because she's or he's getting 60%. But after we run this through the tax ringer, they both end up with more money than if they'd received 50% each. We not only want to pass along our assets to our heirs, but we want to pass along our values to them. Family meetings and conversations with children is critical to have a successful legacy. Everything works better after your death if there have been communications during your lifetime. In conclusion, legacy planning is important. All these things happen after your death, but you must prepare and plan for them prior to death. Everything relates back to funding the lifestyle that you want to live. But when we're gone, we want what's left to go to our children and our grandchildren in the most tax-efficient way. And after giving thought to your beneficiary's tax situation, make sure your estate planning documents and your beneficiary designations are current. Let's build a plan for the family to lose the least amount of wealth over multiple generations. If you have any questions, please feel free to reach out to us. We created a 5-page workbook, Strategies for Retirement Transitions, that I use as the basis for our discussion in this series. If you'd like a copy, please email marketing@elevate-wealth.com, and we will gladly email you a copy.